The dollar index just hit the 99th percentile, and dollar strength at this level puts pressure on emerging markets and commodities. Something is breaking beneath the surface, and the data confirms it. Right now, the dollar index is at 101.7, the 99th percentile for the past year. Historically, dollar strength at this level puts pressure on emerging markets and commodities. Snider says the eurodollar system is tightening and nobody sees it. The dollar analyst says the dollar will surge as global liquidity contracts, crushing everything else. In the next few minutes, I will show you who the data says is right and what it means for your money this month. The scoreboard just changed. A scoreboard flip means the numbers shifted. Pay attention to what moved and why. Score 1 for the dollar analyst. Dollar milkshake higher. The dollar index agrees at 101.7. 8 days running, Gammon just moved from wrong to right. Gammon's credit will blowout call is paying off. Yield curve at 0.30% and trending their direction. Snider just moved from wrong to right. Snider's dollar liquidity crisis call is paying off. Yield curve at 0.30% and trending their direction. McElroy is waiting on confirmation. The narrative holds, but the data has not validated it yet. 186-day streak, Hartman is waiting on confirmation. The narrative holds, but the data has not validated it yet. 180-day streak, bad stretch for the volatility expert, for now. VIX at 19.5 says the opposite of volatility expansion. 8 days running, bad stretch for the commodity analyst, for now. Oil at $69.6 says the opposite of commodity supercycle. 3 days running, score today. 3 right, 2 early, 2 wrong. When a speaker moves on the scoreboard, it means the data changed, not the opinion. That distinction matters. Today's big question. Everyone agrees on dollar, so who's wrong? Snider says the eurodollar system is tightening and nobody sees it. The dollar analyst says the dollar will surge as global liquidity contracts, crushing everything else. Everyone agrees. In markets, that is usually the setup for a reversal. The crowd is most confident right before the data breaks against them. Here is what the data says. The dollar index at 101.7, 99th percentile, 99th percentile. Gold at $4,000, 32nd percentile, up 0.2% today. Bitcoin at about $61,000, first percentile, up 0.4% today. Bottom line, the consensus is bearish, and the dollar index at the 99th percentile says they might be right. But crowded trades unwind fast. If the dollar index breaks below 99, the milkshake theory loses its legs. Right now, it is at 101.7. If gold and Bitcoin both rally while the dollar holds, the liquidity thesis is wrong. The dollar index at 101.7 is in the 99th percentile, reversal territory. If it drops below the 75th, the thesis weakens fast. Gold at $4,000. We'll track it daily on the scoreboard. None of the 7 are talking about this next signal, and they should be. High yield spread just surged 2.3% to 271 basis points. A move this size demands attention. Historically, high yield stress at this level signals institutional risk, aversion building. None of the 7 are talking about this. Keep it on your radar. Phase 1 is the good times, but good times do not last forever. Here is how close we are to the edge. We are 76 basis points away from Phase 2, the phase where credit breaks and volatility spikes. There is no acceleration in credit stress yet, but we are watching the pace, not just the level. The trigger, investment-grade spread crossing 150 basis points. Currently at 74 basis points. Pace is flat or improving. No urgency right now. Phase 1 means risk on is working. Equities, commodities, and real estate all benefit from loose conditions. Enjoy it while it lasts. For context, the last time credit stress built like this, credit spreads blew out and high-yield bonds saw drawdowns of 15%. The credit and rates layer has CFNAI, equity risk premium flashing red. Gammon says the Fed is breaking things and credit spreads will blow out. The data agrees with that assessment. Phase 1 holds with 76 basis points of buffer. Conditions favor risk, but do not get complacent. Wall Street trades the index. We trade the ground. Here is what the zip level data is screaming about today. Jefferson, AL. People moving in can't afford to live here. 22,742 households moved into Jefferson, AL. Their average income, about $67,000. Median home, about $926,000. Unsustainable migration pattern, Demand without purchasing power. MD, days on market is spiking in Baltimore. Days on market in Baltimore moved plus 100% in 30 days, now 163 days. Buyer leverage score, 75-100. Days on market is the cleanest leading indicator we have. Big swings mean liquidity is changing fast. NY, days on market is spiking in Kingston. Days on market in Kingston moved plus 100% in 30 days, now 127 days. Buyer leverage score, 75-100. Days on market is the cleanest leading indicator we have. Big swings mean liquidity is changing fast. These are not hand-picked metros. They are the loudest signals in the housing data right now, chosen by the numbers, not the narrative. Today's debate asked, everyone agrees on dollar, so who's wrong? Let me show you what happened the last time we were here. The dollar index at 101.7 is in the 99th percentile. That means it is higher than 99 out of 100 days in the past year. In 2022, dollar index hit 114, crushing emerging market currencies and commodities. In 2020, dollar spiked during the March liquidity crisis, then reversed on Fed intervention. In 2015, dollar strength crushed commodity exporters and triggered EM currency crises. Different environments, different catalysts. But every time, the resolution came fast. The pattern is not the level, it is the speed of the move once it starts. Meanwhile, Bitcoin at about $61,000 is in the first percentile. The last time both the dollar index and Bitcoin were at these levels simultaneously, the resolution came within weeks. That is why the scoreboard matters. It tells you which speakers saw it coming and which ones missed it. If history rhymes, Snider should be paying close attention because the clock is ticking on this pattern. Here is what the data says to do right now. Stay alert on VIX. It is surging 12.8% today. Fast moves demand attention. Avoid Phoenix at 41% payment burden. That is stretch territory. Watch high yield spread. It surged 2.3% and nobody is talking about it. Every signal is live at analyze.builderslens.com. The podcasters give you the thesis. We give you the scoreboard. Subscribe and I will see you tomorrow morning.